Hello everyone, I am Dr. Swati Gupta and today I am going to explain about IPO, Initial Public Offering. IPO is the process by which a company offers its shares to the public for the first time. A company issues new shares in the form of an IPO. After the IPO comes, the shares are listed on a stock exchange and can be bought and sold in the secondary market. For example, suppose a company that makes electric bike. It wants to grow its business, so company decides to raise fund by selling its shares to the public through an IPO. After the IPO is listed, we can buy shares of this company on the stock exchange. By purchasing its shares, we become a part owner of the company. Now, key aspects of an IPO. First, raising capital. When a company needs fund to grow, pay off old debt, or start new projects, it can sell a part of its shares to the public through an IPO, and the money collected from IPO is used to improve the business, to expand the business. Second, ownership stake. When a company offers its shares in an IPO, it allows people to buy those shares and become part owner. Owning a share means owning a small piece of the company. After the IPO, these shares can be bought and sold in the secondary market. For example, if you buy 100 shares of a company, you own a small percentage of that company and can get profit if the company grows. Why do companies launch IPOs? First, to raise capital. As I told you, company needs fund to expand their business, to start new project or to pay off debt. Second, to gain trust and visibility. When IPO is listed on a stock exchange, it makes the company more credible and known to people. Third, to provide liquidity for shareholders. Early investors can sell their shares after the IPO is listed to earn profits. Fourth, to attract employees. Public companies can offer stock options to their employees so that they get motivation and work hard. Now, process of an IPO. First, planning. The company evaluates the finances and decides how many shares they have to sell and what should be the ideal price for it. For this, company hires experts like financial advisors and underwriters. Second, filing and approval. The company submits a prospectus to regulatory authorities like SEBI in India for approval. Third, pricing. The underwriters decide the share price based on the company's value and how much investors are willing to pay. Fourth, public offering. The shares are offered to investors. Some shares are reserved for institutions and others are open for the public. Fifth, listing and trading. After the IPO, the shares are listed on a stock exchange like NSE or BSE in India. The shares are made available to the public. Investors can purchase and sell shares in the secondary market. Now, important terms used in the IPO. First, underwriter. A financial expert or institution that helps the company to handle the IPO process is called underwriter. Second, prospectus. It is a document that explains the company's business, its risk and financial performance. Third, offer price. The price at which shares are sold during the IPO. Fourth, lockup period. A time when early investors cannot sell their shares after the IPO. Generally, it is 3 to 6 months. Fifth, oversubscription. When demand for shares is higher than the number of shares available, then it is called oversubscription. Now, advantage of an IPO. First, for companies, company issues IPO to raise funds and collect money directly from investors. This money may be used for expanding business, launching new projects, or reducing debt. When company launches its IPO, it builds trust and visibility among customers and investors. When a company provides stock options for the employees, it makes the company attractive to skilled workers. Now for investors, investors purchase shares directly from the issuing company through an IPO. They purchase shares at a fixed price determined by the company. Price offered in this market is at a discounted rate, so investors get benefits. If the company does well, the share price may rise, giving good returns to the investors. Now, risk of investing in an IPO. First, price fluctuation. After the IPO, share price can go up or down quickly. Second, uncertainty. Since the company is new to the stock market, it might be hard to predict how well it will perform. Third, overvaluation. Sometimes IPOs are priced too high and share price may fall after listing. Thus, we can say that an IPO gives an opportunity to companies to raise funds and grow. For investors also, it is an opportunity to invest in a company in the growing stage. But IPO come with risk also, so it is important to research and understand the company properly before investing. Thank you.